Hi there. Let's talk about taxes. Of course, it's your favorite topic, but here's the thing. Taxes are one of the biggest expenses that you'll face in retirement, and it might feel like there's no way for you to reduce them. The truth is there are plenty of strategies that you can use today to lower your tax bill in retirement. You really just need to know where to look. In this video, I'm going to share 4 powerful strategies that can help you keep more of what you've earned, not only for yourself, but also for your family too. Whether you're thinking about enjoying more of your money now, maybe having some fun, maybe taking some trips, or even building a legacy for your kids and grandkids, I think that these ideas will make a big difference. So let me tell you about Bob and Nancy. They're a successful couple who've done well for themselves. Bob built a thriving business and Nancy was a very savvy investor. And together they built very comfortable lives for themselves and for their kids. But here's the issue. They feel like every year they're handing over way too much of their hard-earned money to the IRS, especially in retirement. Does that sound familiar to you? Well, when Bob and Nancy came to me, they said, we want to keep more of our money. We're sick of paying the government. We want to keep it for us. And then we also want to make sure that it passes to our kids and also to our grandkids. So what can we do? After reviewing their situation, we found a few ideas that help them save hundreds of thousands of dollars. And I'm going to share with you a few of those ideas today. First, we use this strategy called tax loss harvesting. It sounds pretty fancy, but it's actually really simple. When an investment isn't performing, when it's down, you can sell it at a loss and use that loss to offset gains in other places. For example, Bob and Nancy in 2022, they had $1 million account in their living trust. Not their IRA, not their 401k, this was a taxable account. And if you all remember in 2022, the market was down 20%, right? Bonds were down 20% and cash was paying 0. There was really nowhere to hide. So Bob and Nancy's account, unfortunately, was down 20%. And so what we did is we actually sold those assets. So it went from $1 million down to $800,000. We sold those assets. We sold them one day. The next day, we bought similar investments. Maybe different mutual funds, maybe a different mutual fund family, or a different type of fund. But it was the same allocation. And what it did is it allowed them to capture a $200,000 loss. Now, let me tell you, no one ever wakes up in the morning and wants to lose money, right? No one ever says, yay, I can't wait to lose money. But the good news is that they captured that loss. And since then, their accounts are up significantly. They were able to use that $200,000 loss against all their future gains. You see, they live in a high tax state, as high as 35%. So that saved them somewhere in the neighborhood of $70,000 or so. So they saved $70,000 in taxes just by making that one adjustment. It didn't affect their allocation. It didn't affect their portfolio. It didn't affect their return, but it saved them 70 grand in taxes. And so you can imagine Bob and Nancy were very, very happy. And the neat thing also is that money, actually we used the $70,000, we used that money to help their kids and their grandkids. Specifically, we used it to help their grandkids pay for college. Next, we focused on this idea of asset location. Asset location is an idea that allows us to organize your investments in a certain way. The idea is we want to put your high tax paying assets inside your IRAs and 401ks and your low tax paying assets inside your trust accounts and your taxable accounts. So for example, we could put your real estate accounts or maybe your actively managed small cap or international funds inside your IRAs because those assets have higher taxes. And we would put municipal bonds, tax efficient index funds, and individual stocks or bonds inside your trust account or your taxable account. So for Bob and Nancy, they had a $3 million investment in their accounts. It was split between their IRAs and their trusts. And by doing asset location, oftentimes we find that we're able to save clients 2 or 3% in return. And for Bob and Nancy, they saved 2%. It doesn't sound like a lot, big deal, right? 2 or 3%, but over 20 years, that can add up to be another 2/3 or so of their portfolio. So that's another almost $2 million they can use over the next 20 years to live on. They can use it to take trips, they can gift it to their kids, their grandkids, or they can leave it to their family. Another popular strategy that maybe you've heard of is a Roth conversion. It's one of my favorites, and it's perfect for reducing taxes over time, and here's how it works. If you're in a lower tax bracket, maybe you retired or you have a lower income year, you can move money from your traditional IRA or your 401k into a Roth IRA. You pay taxes on the amount you convert right now, but then the money grows tax-free and it stays tax-free forever. So Bob and Nancy, we created a 5-year Roth conversion plan. They converted $500,000 over that 5 years. Unfortunately, they paid over $100,000 in taxes, which sounds like a lot, which is a lot. But here's the payoff. In 20 years, that $500,000 could grow to $1.5 million, and now it's all completely tax-free. So it's not only completely tax-free for Bob and Nancy, it's also completely tax-free for their children and for their grandchildren. And so they know that when their kids or grandkids inherit this money, they're going to get it tax-free. As well, they know that if they decide not to give it to their kids and they want to spend it on a cruise, or maybe they want to experience that money with their children or their grandchildren while they're alive, they can use that money tax-free. So you might be thinking to yourself, well, that's great for Bob and Nancy, but what about me? The good news is these ideas aren't unique to them. They can work for almost anyone who takes the time to actually put out a plan. And the fact is that you've worked hard for your money, and the IRS doesn't need more of it. And with the right strategies, you can protect your wealth. You can reduce your tax burden, and you can feel confident about your family's future. I want to thank you for watching, and if you found this helpful, share it with someone, or maybe they'll benefit. I look forward to seeing you on the next one.